Welcome to this explainer, everyone. Today, we are cracking wide open our AS4 exam study guide. Specifically, we're tackling contingencies and events occurring after the balance sheet date. Look, I know accounting standards can sometimes feel like trying to untangle a giant, messy knot, right? But don't worry, we're going to break down this ICAI module-aligned material together. We're going to use some crystal clear visuals so you can confidently tackle absolutely anything the examiners try to throw your way. Let's get into it.
So let's dive right into a high-stakes scenario, one that literally trips students up every single year. Picture this. It's 2 days after your financial year end. The books are closed, you're breathing a sigh of relief, but then a massive flood suddenly wipes out your main warehouse. Do you go back and change the numbers on the balance sheet you just finished, or, do you just leave it alone? Keep your answer in mind, because by the end of this session, we're going to know exactly how to handle this. And more importantly, we'll know exactly why. All right, here is our roadmap for today. We'll start with a welcome to AS4, move on to mastering financial contingencies, then tackle events after the balance sheet, navigate the proposed dividend dilemma, and finish up with some killer exam secrets and memory tricks.
Starting us off, Section 1. Welcome to AS4, defining the scope.
So, before we do anything else, we absolutely have to establish the exact time frame that AS4 actually cares about. Think of this as the danger zone. It's that critical window of time right between your balance sheet date and the date the financial statements are officially approved by the board. If something wild happens in this specific window, AS4 kicks in and dictates exactly how you have to report it. It's a really tense period because honestly the numbers can still change.
Moving right along to Section 2, Mastering Financial Contingencies, Handling Uncertainties. Okay, to master this, we first need to get a grip on what the standard actually means by a contingency. Formally, it's a condition or situation whose ultimate outcome depends on the occurrence or non-occurrence of one or more uncertain future events. But simply put, these are your pending court cases, your messy tax disputes, unresolved insurance claims, basically situations where the future is still totally hazy. You know something might happen, you just don't have the final verdict yet. So how on earth do you account for a situation that's fundamentally unresolved?
Well, the standard gives us a very strict binary contrast here, and this is absolutely crucial. For a loss contingency, you've got to actually recognize that loss in your books immediately if it's probable and the amount can be reasonably estimated. But for a gain contingency, hard stop. No way. You do not recognize anticipated gains. You literally have to wait until its realization becomes virtually certain. This asymmetry, booking likely losses but ignoring likely gains, is all about prudence, and it's incredibly important to remember for your exam.
All right, Section 3, Events After the Balance Sheet, the core exam focus.
Now we are getting into the absolute most frequently tested area of your exam. We basically divide all events that happen in that danger zone window into two buckets. Bucket 1, adjusting events. These provide evidence of conditions that already existed on the balance sheet date. For these, you must adjust the financial statements. Bucket 2, non-adjusting events. These are conditions that arose entirely after the balance sheet date. For these, you do not adjust the financials, but you do have to disclose them if they're material. So it all boils down to one simple question. When did the root cause actually exist? Was it sitting there on the balance sheet date, or is this a brand new problem?
Time for a rapid-fire pop quiz to test that exact logic. Imagine a major customer is officially declared bankrupt shortly after your balance sheet date. But you actually know their financial difficulty existed well before the year end. How do you treat this bankrupt customer? Do you adjust the statements or just disclose the event?
You must adjust the financials. Why? Because that official insolvency is really just the final nail in the coffin, providing solid evidence that the debtor was already impaired at year end. The core condition, their terrible financial health, already existed on the balance sheet date, so boom, it's an adjusting event and you've got to reduce your receivables accordingly.
Okay, back-to-back testing. Let's revisit that high-stakes scenario from the very beginning of our explainer. What if that warehouse flood, or maybe a massive fire, happens right after the year end? Adjust or disclose?
The answer is disclose only. You absolutely do not adjust the financial statements for this. Since the condition, the actual fire or flood, arose strictly after the balance sheet date, it is a textbook non-adjusting event. You just disclose the nature of the event and its financial impact in the notes, assuming it's material, of course. Think about it. If you went back and adjusted the balance sheet, you'd be totally misrepresenting the reality of the assets that were perfectly fine and sitting right there on the final day of the financial year.
Let's keep moving. Section 4, the proposed dividend dilemma. Timing is everything.
You'll want to pay very close attention here, because examiners love to set this specific trap. If a dividend is declared after the balance sheet date but before the financials are approved, it is absolutely not a liability at the balance sheet date. You do not recognize it as a payable. Because the actual declaration happened after year-end, there was no present obligation on the balance sheet date itself. AS4 mandates that this requires disclosure in the notes to the accounts only. Seriously, do not let this trip you up on exam day.
Finally, Section 5, Exam Secrets and Memory Tricks. Unlocking your cheat codes.
Okay, you've survived the boot camp so far. Now let's get you some cheat codes. Commit the AD&D rule to memory right now. It's elegantly simple, but it is a lifesaver when you're staring down a massive list of events in a complex question. AD stands for adjusting event, which means you adjust the accounts. ND stands for non-adjusting event, which means you simply write a note, meaning disclosure only. So AD means adjust, ND means note. Easy, right?
And then we have the PLG rule, which flawlessly simplifies your contingencies. When you're analyzing an uncertain future event, just run it through this quick filter. P stands for probable loss. If it's probable, you provide for it. L stands for loss possible. If it's merely possible but not quite probable, that's disclosure only. And G stands for gain. If it's a gain contingency, you completely ignore it until it is virtually certain. So, provide for probable, disclose the possible, and wait on the gains.
Let's bring all of this together into a quick revision summary. Honestly, take a mental screenshot of this right now. At the top, we see our PLG rule in action. Probable losses get a provision, possible losses get disclosure, remote losses get nothing, and gain contingencies are completely ignored until virtually certain. And right below that, our AD&D rule. Adjusting events mean you adjust the accounts, while non-adjusting events require disclosure only. When you are doing your final cram session, this summary is going to be your absolute best friend.
As the official ICAI exam tip reminds us, the absolute most frequently tested area in AS4 is distinguishing between these adjusting and non-adjusting events. This distinction is literally everything. Did the condition exist on the balance sheet date or did it arise after? As you wrap up your work with this AS4 exam study guide, ask yourself, when presented with a brand new, super tricky scenario, can you confidently spot the difference? Your score really does depend on it, so practice that logic until these rules are second nature. You got this.